A wonderful good morning, ladies and gentlemen, and welcome to NAGA and Markets for Breakfast. My name is Alex Duvidari. Today is December the 20th, 2019. It is very close to. Actually, it's a Friday, so it's the last day of this week. Then we're going to have a weekend, and after that, it's going to be Monday, Tuesday, with somewhat reduced trading, I would expect, compared to what we usually see, and then go into the Christmas holiday. Now, saying about, or that said, there's still some stuff going on here that we want to have a look at and navigate through what's ahead of us today on this Friday. So, first of all, what we continue to see is that when we look at the markets, that there is what can I say? A persistence in the price of the stocks in the US. We see that the S&P 500 took the 3,200 yesterday and has actually just raced to another all-time high here and remains to be quite high. Now, even with this whole impeachment thing going on, the markets cannot be derailed that easily. And now we're looking at a couple of possible scenarios here that are ahead of us. Now, first of all, what we want to see is that since 2000 or in this year, the Fed has dramatically, as we know, started to expand its balance sheet. By the way, at the fastest pace since the financial crisis, in order to fix the inverted yield curve. Right? That's what we've like a few months ago. You probably heard it again and again and again that there was. The yield curve was inverted, meaning that longer term bonds were paying less than short term bonds, and that this is usually a sign for a recession about 10 to 12 months later. Now, since the Fed has stepped in so heavily, what we've seen is that the yield curve has very much turned around very dramatically, and in a very and it seems not to stop. I mean, look at this one, the last part here. It's like rising to the sky, basically. And long story short, in order not to bore you too much here with those numbers, is that there is a lag to curve inversions to recessions, right? And like 2012, the yield curve inversion happened in July 06, and then we had the recession arrived like 500 days later. So we don't know how much the lag will be here or if it's going to be a lag. But what we're seeing now, and Zero Hedge is writing it here, so be careful what you wish for and celebrate, because celebration means that, hey, look, the yield curve is doing fine again. It's uninverted. But because, as history has shown, the uninverting of the yield curve is when the recessions start and when the markets begin to reflect reality. Now, that I'm not saying that this is going to happen right now, because in a way, with all this cheap money floating around, nobody knows for 100%, but this is what history has shown us, and history was quite accurate about it every single time of these instances here. So it's definitely something that is worth considering and worth to know about, at least. And I think that is what my mandate here is that to provide you with background information that is helpful for you to make your own decision or do your own research, hopefully. So that is something that's not looking all too well. And if you look at the calendar yesterday, what we saw, and I think that's something to really pay attention to, is that no, this is today. Let's go to yesterday. Here we go. So we had yesterday some data out of the US, and you can see like initial jobless claims came in weaker, like more jobless claims. Existing home sales were a little bit less than expected, minus 1.7%. We saw the Philly Fed come in weaker. The Philly Fed capex index came in weaker. So there was a entourage of U.S. data that was not doing well, And what happened? Well, the market shrugged it off, saying like, "Hey, it's all gonna be fine," since we're now having the deal with the US and with China happening, and that should be all good, and that's what they have been. Yeah, basically the narrative here that has been pushing the markets up. And if we look at, I think it was Liz Ann here, one second, showing like where is the market actually invested. If that lovely Twitter opens, okay, here we go. By the way, the fear and greed index has now reached an 87. This is really historical stuff going on here. And by the way, that impeachment thing I wanted to show is that the trends in the presidential approval rating. This is the approval rating of Donald Trump. And ever since the impeachment came, boom, he skyrocketed. He's become a lot more approved, or his approval ratings went through the roof, basically showing that this impeachment thing is not really supported by the average American people. Which, by the way, again, those American people, they lack savings. 45% of all Americans don't have $0 saved. Zero. We're talking about the most abundant economy of the world, and 45% of the people there don't live from paycheck to paycheck. So that's not necessarily really a good development here. And that what I'm trying to say is that as soon as we get some jitters, some issues, some whatever, these things could become quite problematic, as people don't have any savings at all. And here, for example, the yield curve now uninverted, signs of economic stabilization. Well, we just made a case that it might not be. I wanted to show you something else. I'm not finding it right now. Not so important. It's not the end of the world. So what we see is that and let's have a look at maybe the NASDAQ, because a lot of the money is in tech stocks, right? The tech giants are the number one go-to. And you see that the NASDAQ raced up to highs here. And the expectation is that that phase one deal really be signed in January. So Mnuchin yesterday, head of the Treasury in the U.S., obviously you know that, said that the U.S.-China trade deal will be signed in January, and that also were headlines in CNBC. And he said that everything is on paper now and translated, and is not open to renegotiation. So it's going through some technical legal scrub, and the U.S. priority on trade with China right now is to implement phase one deal, and they are prepared to work hard on phase two deal. And for the first time, we have binding enforcement. If disputes are not resolved, the president has the authorization to put on tariffs. And that is what the U.S. side is saying. The Chinese Commerce Ministry said that the phase one trade deal content will be disclosed after the deal is signed. And they also said that the U.S. and China trade teams are in close communication. So you can see again that one side is showing a little bit different than the other side. So let's see where this is going, and if this deal is really happening, or if we are really on the verge of a bigger disaster, meaning people having no savings, economies start to hurt more and more and more, investors realizing that they have such a high price to fall from, and and these things could unwind in the new year quite ugly, I guess. But for now, it looks like it's Christmas, so grab what's yours, and the price continues to go up. So that is the direction here. Meanwhile, when you look at for other markets, like for example the German DAX, you can see that it's not been showing any of these signs here, and it didn't even have negative economic data. On the contrary, for the first time it was showing some promising data, and still it's not really showing any positive development here. And that tells me a little bit of a story to become more cautious now around year end. We've had a Christmas rally, or we still have a Christmas rally pretty much going on in the US, but we're also coming towards the lower end of it. What else do we have? Let's have a look at, that's a different thing here. The high flyers remain basically the Australian dollar and the Kiwi. Even the Kiwi now saw a little bit of a setback on the day, but coming from the 66 level, that important 66 level, right? We talked about it repeatedly, and it's still in play. So with the positive GDP development in New Zealand, that is still a supportive reason here for those, and especially also the the pricing out of the risk of the China-US deal not happening is helpful for the Kiwi. So if I'd look at those, I still think they have a good chance to go. Both of them, the Aussie and the Kiwi here. Meanwhile, the yen is not doing all too well, even though we can see that the dollar came a little bit back down here. We can have a look at the dollar in total also, where you can see the dollar's still showing strength here. So it's not really a dollar weakness story. And we had the Bank of Japan. Nothing really changed here either, by the way, and that is not really a market right now, in my opinion, to be in that has most of the music playing. Interestingly, the pound actually continued to drop yesterday. The fear of Boris Johnson really doing something dramatic or continues to push the price lower. And it wasn't just that. Even when you look at the calendar yesterday, remember we talked about retail sales, right? Here, pound retail sales dragged it further down, and chances are the pound could come further down from where we are right now. Still lower than a 130 level. Here we go with the chart, just so you can see that we are right around the 130 level, and that's exactly, that support resistance area between that, let's just say November levels, late November levels, until we had that pre-election euphoria set in, and now really comes down back hard to reality, because we had a very dismal November retail sales, and it didn't include Black Friday yet, so we'll have to wait for the next time around. But also the Bank of England was very uneventful, and it was like going in both directions, so it's very much a wait and see. They were saying, like, if global growth fails to stabilize or Brexit uncertainties remain entrenched, monetary policy may need to reinforce expected UK recovery, meaning dovish. They need to help. On the other hand, the Bank of England said that if risks do not materialize and the economy recovers broadly as expected, some modest tightening of policy may be needed. That would be like very hawkish, actually, letting the pound rise here. But right now, the fear of Boris Johnson really causing a lot of trouble is big, and so it's impossible to do a comprehensive deal between the EU and the UK in that amount of time that he is suggesting. But he is very clear on that. He said that we will avoid the trap of further dither and delay by ruling out any extension. So that pushes the possibility of the pound to lose further, in my opinion, very clearly. So that's also something to pay attention to. Elsewhere, when we look at the calendar further today, something we want to pay a lot of attention to is the PCE. Remember on the last Fed meeting is that Jay Powell, head of the Fed, said that there was no inflation or the PCE was stable. This is the kind of thing that he looks for, the core PCE and the PCE price index. So watch for those numbers that are really coming in here, plus the US GDP before that, earlier in the afternoon. These are most important data points for both the economic health and the state of the inflation that the Fed actually looks at. So those are the most important market moving calendar entries for the day, and they're very much relevant to US dollar movements. So watch for that mainly. We will have retail sales also out of Canada. That could be interesting. The Canadian dollar itself took a little bit of a hit yesterday, but with the price of oil remaining relatively supported also, or quite high actually, we got the 61 level. We didn't move much yesterday, all in all, on oil, but we captured the 61 and remained on the 61, so that is for oil bulls positive, and that's also supportive of the Canadian dollar, even though the Canadian dollar took a little bit of a hit yesterday. we could see some recovery here, really bringing it further down here. Especially, let's just say we get good retail sales out of Canada today. We see maybe a decline in the U.S. GDP, or a decline in the PCE numbers. That would at least be supportive of the Fed for sure not rising rates anytime soon. These could weaken the dollar a little bit, and we can very easily see a 131, maybe even a break over 131 here in the dollar Canadian dollar. So that's something also to very much pay attention to. From another perspective, well, the euro is pretty much directionless at the moment. I wouldn't go too much into it. And then we have also the story with the Turkish lira. So the Turkish lira on a daily, you can see, was going losing for a while now, and went back to one of its highest levels in this year. Not completely, but quite. You see that resistance area here, basically a little bit ahead of the 6 level. And now the central bank in Turkey intervene, and they are limiting the amount of hard currency local banks can exchange for lira with foreign investors, a move that could benefit the central bank by pushing dollar liquidity into its official reserve. So meaning here, derivatives, and that's also a bigger thing here. We will limit the amount of foreign exchange swaps, forwards, and other derivatives with a maturity of 7 days or less to a maximum of 10% of the bank's equity. So that has been dropping the swaps heavily in the Turkish lira, and that in fact means that carry traders holding Turkish lira positions, but collecting swap on them, will have a reason to close down their positions, in fact, and that could help the lira to come back, to see some movement of strength, meaning that the dollar Turkish lira could see some movement back down from where we are right now here, with the combination of that restriction from the central bank or the regulator, and maybe something that could be dollar weak today, later in the afternoon, could help here. That would be double impact to the right side. So watch for that also as a possible interesting trade here on the sideline. Meanwhile, we see that gold is really, still holding here. We went up to the 1480 level in between. We did not break that level, but we're holding very, 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 very close to it. So I remain quite bullish on gold, despite that it has been losing since September, but I continue to see that 1480 has a good chance of break to the upside. So watch for the dollar. Watch what's going to happen today. If the dollar shows some weaknesses, if we see some inflationary weaknesses in the US, gold could see some upside here. And apart from that, we can see that on the crypto side, Bitcoin has, after its reject here yesterday that brought it back up to 7,400, it's holding quite still, and we're back at the lower end of that 7k level, still holding for now. But this is not a nice place to be. This is the same place to be like here, and eventually you saw what happened. So we need to see that being reached, and that in order to see the price come back up here. First the 7.2, then the 7.4, then the 7.7. Those are kind of achievements the price need to see, and if it doesn't, chances are we break below the 7,000 quite quickly again. So that is what my expectation here when it comes to the crypto king goes. And when we look at the other, like for example Ripple and Ethereum, we can see that they're not doing all too well themselves as well. So Ripple, usually one or more of the more volatile, is already trading more or less at the lower levels before that reject here, and that is not a positive sign for the rest of the cryptos either. We can have a look at Ethereum, where it's still half actually. So but all in all, we are very not really seeing positive developments in any of the crypto so far. So as they say, it is a crypto winter. So that's my overview of the markets this morning. I'm still positive about the Antipodeans, like the Aussie, like the Kiwi. I think the Lira could see some a little bit of strength today on that central bank intervention. The Euro is a little bit directionless. The pound has more reasons to fall. and watch for the US dollar data and out of Canada later this afternoon. That would be most of the things I would pay attention to today. So as always, thank you very much for listening in. I wish you a great, successful trading day, and we'll be back here on Monday morning. Bye bye.